Hey guys, and welcome back to the Young Investors Podcast. We're back again with episode 55 today, and joining me as always is Brandon. What's going on, Brandon?
Hello. Oh, not a lot. I was really tired this morning, actually. I was staying up last night. I'm watching this, I started watching this Netflix series. Have you seen the Explained series on Netflix?
I've seen some of them, yeah.
Yeah, I don't know. I just didn't even know it existed, and I started watching last night. I watched the one about music. Have you seen that one?
No, I haven't.
It's so bizarre. It makes sense. They were talking about how weird of an idea music is, like from a species standpoint. I know this has got nothing to do with the stock market, but it's just like I was reading it. I was watching it, and there's like no other species, or there's like only a few species that can like tap to a beat or like understand what a beat is. Like nobody else can. It was really strange. They were even testing like monkeys, and they found that even the monkeys, when they were reacting to a beat, they weren't actually tapping with it. Anyway, not related, but I was getting super into this series. Yeah, it was crazy. It's really interesting.
I'll have to check that out.
Yeah, I'm gonna watch so many more of them. They're so interesting. They're only like 20 minutes, I think. So anyway.
Anyway, guys, moving on from that. No.
Yeah.
But we've got couple of news stories today. We've got Disney reported some earnings. We've got some Trump tariff stuff.
Yep.
And then we're going to get into the main section, and we're going to be talking about Charlie Munger. So we did an episode a while back where we went through Warren Buffett and some of his quotes and his philosophy and that sort of thing. So we thought we would do the same thing for Charlie Munger today, go through his philosophy, sort of who he is, if some of you might not know who he is, and then talk about some of the major quotes and sort of, investing principles that he lives by.
Yeah.
And then towards the end, again, of course, we've got some Q&A questions. So if you have any questions for next week, head over to the YouTube version of the podcast at youtube.com/Hamish Hodder and click on the video version of it and leave us a comment there. You can leave us a topic or a question, and we will check them both out. But before we get started, we do have a sponsor for today.
Yep.
Do you want to run us through that?
Yeah, sure. So, of course, as the past few weeks have been, this episode is sponsored by Hypercharts. So, if you guys haven't checked out Hypercharts, what are you doing? Hypercharts is basically just a website where all of the tricky numbers that you find in the annual reports, like all of the revenues and net income and blah, 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 all of those tricky financial numbers, they just take them all and they put them into nice graphs. So you can just look at the trends year over year, or quarter over quarter over quarter over quarter, and you can just see really nice, easy to understand information on all different companies. And as we've been saying as well, the good thing about Hypercharts is that they give you some really industry or company specific KPIs in there as well. So you won't just get the financial data, but you'll also get some interesting data for that company in particular. So it does help you get a fair bit of context. Now, most of the information over there is free, so you can just go to hypercharts.co and just have a play around with it, because I think you'll find it's actually really useful. But if you did want to check out, they do have a premium mode, which just gives you further in-depth charting. It helps you compare different companies on the same page, doing that sort of stuff. You can put the earnings calendar on your personal smart device. You can get the results of a particular company sent straight to your email address. And if you wanted to check out the premium mode, they've got a 2-week free trial. So you can check that out, hypercharts.co/premium. And yeah, thanks to Hypercharts for sponsoring this episode.
Beautiful. So with that completed, let's get into some indices. So in terms of the Dow Jones, it was up 0.97%. For the week, we had the Nasdaq up 0.33%. We had the S&P 500 up 0.45%. We had the ASX 200 up 0.7%, and the All Ordinaries up 0.7%. So a nice green week for the markets.
Yeah, I think it's just the market. We'll get into our first news story. I think it's just in America, the market seemed to like the idea of Trump, or not even Trump, but just the US and China kind of starting to discuss a bit of a truce in rolling back some of these tariffs. So I don't know a huge amount, because I really don't look into this stuff too much, but they have been talking, the Americans and the Chinese, that they're going to settle on some sort of deal to roll back the tariffs that have been put in place. They're thinking about doing it in stages. I suppose as what they've done, they've put the tariffs on in stages, so I guess they're going to take them off in stages. The only thing that I really took out of the quick research that I did is that China are going to press pretty hard that they get treated as equals in all of this. So I don't think they'll agree to anything unless it's fair for them. That's kind of the gist that I got. So they don't want to let America be the bully in this situation. But I don't really know too much about it. So I guess we'll just have to see what happens. See if they actually, they haven't agreed to anything. They've just kind of put the thought out there, the idea out there, and then I think they've got to come to some decision. But yeah, I'm sure we'll hear much more about this, much more explaining.
Yeah, it's certainly something I don't know a whole lot about, but it'll be interesting to see what happens, because I think regardless of the contents within the trade deal, if there is a trade deal, I think it would most certainly be positive for the market, at least in the short term, just because it's kind of it's a big event. I think many investors are kind of waiting for some kind of deal to come out of this, and maybe not a lot of people would kind of look into what actually is the substance of a trade deal. And I mean, I presume Trump would most definitely want to make some kind of deal before the election next year, so that he's got something. So he's actually done something.
Look, guys, I did it.
So yeah, he actually achieved something.
Yeah.
But it'll be interesting. And I mean, we've been saying it'll be interesting for years now. So
it's been crazy. This has been the one news story that just hasn't gone away. It's been with this podcast the whole way through. We've been doing this podcast for over a year. It's crazy. It's just it's still raging. Just they haven't been able to do anything about it yet. But maybe a step in the right direction here.
Yeah, we will see.
Yeah. All right, shall we move on to Disney?
Yeah, so Disney reported their full year earnings, so their fourth quarter and full year earnings. And it sent the stock up a little bit. The market liked it, 3.6% overnight. Yeah. So what happened with Disney?
Well, basically, they had obviously their fourth quarter results and their full year results come out. So if we have a look just from quarter to quarter, they had, or rather from this quarter to this quarter last year, they had revenue up 34% in Q4 versus Q4 2018, which is pretty decent. But if you have a look at the yearly numbers, they only had revenue up 17% in 2019 versus 2018. Then if you have a look down at their operating income, you'll see that they only grew 5% in the last quarter versus Q4 2018. But if you have a look at the yearly numbers, it reduced by 5% in 2019 versus 2018. So operating income is down. Remember, operating income is just like basically the revenues minus the expenses. It's basically whether the business operation itself made or lost money. So having that weakness in the yearly numbers, it also led them to have a 17% reduction in the net income from 2018 to 2019. So for Disney, the one thing to remember is that their business is actually broken down into 4 different business segments. They've got their media networks, they've got their parks and resorts, they've got their studio entertainment, and then their new one, which is their direct-to-consumer or their streaming service segment. Right. So what I wanted to...
I was just going to say, so I guess it's kind of important to look at Disney at each of the segments, because if you just look at the whole thing, net income down 17%, it doesn't really tell us a whole lot about which segment that might have sort of come from.
Yeah. And we know that there's a lot of expenditure going on at Disney at the current time in particular areas. So you'd want to make sure that it is from those areas and not, say, from their theme parks or something like that. Because you're right, Disney is such a diversified entertainment company. Like at one state, like they've got their running Disneyland is one of the core parts of their business. At the same time, building Disney Plus is a big part of their business. So they're completely different things. So yeah, we try and break it down into the four segments, and what you'll find if you break it down into the 4 segments is that if we look at 2018 versus 2019, then media networks, it kind of stayed about the same. Parks and resorts went up by 11% in terms of operating income, this is. Then studio entertainment went down by 11%. And then direct-to-consumer and international, they've put here, went down by more than 100%. So they've got a lot of expenses coming through the direct-to-consumer segment, which is their streaming service segment, which is to be expected. They're in, obviously, a development stage of that, and they're not getting basically any revenues. They're only getting a very small amount of revenues from their pre-existing streaming services, which are ESPN Plus and Hulu, which they bought from 21st Century Fox.
Right, and I believe they have full control over Hulu now.
They do.
I think that
I think they bought out Comcast, had a stake in it.
That's right. Yeah, so they had, I believe they had a small proportion, and then Fox had a proportion as well, and so that already gave them a little bit more. And then once they had majority, then they bought out Comcast, I think. So now they have complete control of that, which is interesting. But yeah, they're not making a lot of money from that or ESPN. But I mean, I guess they are making money from those, but they're also spending a lot of money in that area to build up their Disney Plus.
And they've said that this segment is not going to be profitable for them probably until 2024. So they've got they've got a long way to go before that starts churning positives. But interestingly, so obviously just looking at that, they've got a little reduction in studio entertainment, 11% down, but they're really the area they're bleeding money is in the streaming service stuff. So basically with the streaming service stuff, they posted a loss of $738 million in 2018, and that's up to $1.8 billion in 2019. So it's costing them a lot. Yeah. Anyway, trickling down, let's have a look. The next number they wanted to report is their free cash flow, which actually took a massive hit in 2019, down 89% to 1.1 billion from 2018's 9.8 billion. So I thought this is obviously a dramatic decrease, and at face value I just thought, it's because they're spending so much to build their streaming service, because remember that free cash flow is just their cash flow from operations minus their capital expenditure. So when I went into this, I just thought, it's just going to be their capital expenditure that's going to be up like huge. But there wasn't such a huge change in their capex. Although spending was up about 400 million due to increased theme park expansion and doing their streaming service stuff. But it was actually more a reduction in the operating cash flow for the year, and that was coming from acquisitions. So they actually had an $8.3 billion reduction in cash flow from operations in 2019, so roughly a 58% drop. And I've just jotted down their explanation for this was they say that the decrease was due to the payment of tax obligations that arose from the spin-off of Fox Corporation in connection with the 21st Century Fox acquisition and the sale of the regional sports networks acquired with 21st Century Fox. They also noted higher pension contributions, lower segment operating income, and an increase in film and television production spending and higher interest payments. So there's a couple of things going on, but overall, I'm just super excited, to be honest, with Disney at the moment, because Disney Plus is coming out in less than a week.
Yeah, that's super exciting. And I mean, of course, that means that the next quarter for Disney will be telling us a lot about how that sort of launch went. Maybe not in terms of profitability, of course, it's very early days, but in terms of sort of initial interest in the platform. And we can kind of get a gauge of who's going to be coming across and how that's going to impact Netflix as well. We can start to see that in that first quarter. But I guess going back to just the acquisition stuff, it kind of brings up an interesting point about why companies that consistently make acquisitions are often not very successful. It's often very hard for a business to be successful if they're making a lot of acquisitions. And it's really for two reasons. One is that you have to pay a premium when you're buying such a big company. And the other thing is that there are so many costs associated with it that you have to have such a margin of safety in the buying price that it's actually worth doing.
Costs a lot to integrate everything.
Huge amounts of costs to, just integrate it to everything, synergize everything, and make sure that you get the right executives from this branch and put them over here and make sure all of the studios work well together. It's a huge task, and especially an acquisition the size of 21st Century Fox and Disney. Really, it's a merger because they're both huge billion-dollar companies. It's going to take a lot of work to get that to be profitable together. Yeah, that's exactly right. There's just so many costs in trying to literally merge those two companies in a synergistic way. It'll just take time and it'll take money. But I guess they would have, like Bob Iger would have done some back of the napkin math on it. This is definitely a long-term play for Disney. I mean, Disney's strategy is all about just getting their hands on the original content. I mean, really, that's their whole strategy with this whole streaming service thing, is to try and squash Netflix like a bug because Disney just simply has so much original content. And then they've just done this deal with 21st Century Fox, and they've added a whole nother section to Disney Plus now. Because of that, they've put National Geographic content on Disney Plus, which is owned by 21st Century Fox. So
Yeah, super interesting strategy. And yeah, I'm with you. I'm excited for Disney Plus, but I'm also excited to see the statistics that come out of it in terms of adoption from, or maybe even looking at Netflix subscribers, seeing if they go down or up or whatever. So
yeah, for sure.
Yeah, it'll be cool.
Yeah. All right. Well, with the news completed, let's move into the main section of today's podcast, which is we're going to be talking about Charlie Munger. So,
yeah,
who's Charlie Munger?
I love him. Guy? I love Charlie Munger. He's right up, like he's almost equal with Warren Buffett in my books. Like I really like Charlie Munger. He's just the vice president of Berkshire Hathaway. I think that's his official role. But pretty much you just think of him as Warren Buffett's longtime business partner. They're kind of just friends and they work together and they just bounce ideas off of each other and, they listen to each other and try and critique each other's ideas and that sort of thing. And it's been a very successful partnership for them both over the many years. I think I was listening to some Buffett interview and he was saying that they've now been working together for 54 years or something like that. Yeah.
That's insane. Which
is crazy. But by the way, Charlie Munger, he's like 94 or something like that. So he's very, very old. So, they would have been working, for most of their working life at Berkshire together. I'm going to look that up. Charlie Munger. How old is he?
One thing that I've found interesting is that out of Berkshire Hathaway, really, I guess a lot of people give the majority of the credit to Warren Buffett for that.
Yeah.
And I mean, there would be a lot of people who know who Warren Buffett is and know what Berkshire Hathaway is, but might not know who Charlie Munger is, which is amazing to me because it's actually his strategy, his lifelong strategy of investing that had a big part in influencing how Warren Buffett invests and how Berkshire Hathaway invests in many of the companies that they've invested in. And one thing that I found interesting that I didn't know about Charlie Munger was that he actually ran his own partnership, his own investing partnership.
Oh, really?
Just before joining Berkshire Hathaway.
Oh, okay.
And he ran that for about 12 years, I believe, and he generated a return of about 19% compounded. So
not bad.
He has his own track record on his own as well as within Berkshire Hathaway, and that's something that I was looking for because certainly you can attribute him and Warren Buffett's they've both worked together to build this hugely successful business of Berkshire Hathaway, but I was interested in seeing if Charlie Munger had a track record of his own, and he certainly does.
Yeah. Going back to what you were saying before about how a lot of Warren Buffett's strategy has kind of come from Charlie in a way, there's this really, and I've shown this on my channel before, there's this really awesome quote where he gets asked, Charlie, how do you pick your investments? Like, what do you look for? And the thing that I love about Charlie Munger is that he's straight to the point. He always keeps it so simple. He can explain things so incredibly well. I'm going to read you this quote. This is from, I think, an interview around 2008, 2009. But this is his quote, and this is absolutely verbatim. He says, "We have to deal in things we're capable of understanding. Then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. Then, of course, we would vastly prefer management in place with a lot of integrity and talent. Then finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life." And that's the quote. And what did that take me? All of like 30 seconds to read. And it basically covers every single key point in their investing strategy. Understanding the business, finding a moat, checking the management team, and always demanding margin of safety. I remember when I first came across this quote, I was kind of just learning to invest, trying to learn more about Warren Buffett, and I was reading Phil Town's books and that sort of stuff. And then, I don't know, when I just came across this quote in this interview, I was like, oh, this is it just kind of, it filled me with confidence. I'm like, yep, it actually is that simple. Like, I know there's a lot to it, but all of the stuff that we have to do, ultimately, it just falls under one of those 4 key pillars of investing. So, I don't know.
Yeah.
I love Charlie Munger. I think that's one of the best investing quotes of all time.
It is, and it's fascinating how similar that is to just what Warren Buffett talks about and what sort of Phil Town teaches in his books.
Yeah.
The core philosophy is so simple. It's kind of like, it's simple but hard in that the philosophy itself is very easy to comprehend, but it's hard to go out and apply it and dig deep into each of those areas.
It takes time.
Of course, yeah. But it's fascinating, and we're going to go through sort of a bunch of different quotes that I've pulled that Charlie Munger has spoken about over time, and just sort of dive into how each of them kind of fulfill each of those criterias that he explained in that nice, neat sentence there, where he talks about understanding the business, looking for competitive advantages, assessing management, and looking at the price that you're paying, making sure that you're getting a margin of safety. And all of these quotes kind of go a little bit deeper into explaining each of those. So I think the first... Yeah, so the first one that I had here was that one of his quotes is that he has 3 baskets for investing. Yes, no, and too tough to understand.
Yeah, that's
so
good.
Every business that he comes across falls into one of these 3 baskets. Either it's too tough to understand and immediately he kind of disregards it. And I think maybe we can just start there. I mean, that's something that's really important, and a bit of a discipline that it takes to be an investor is to, when you come across a business, no matter how kind of excited the market is about it, if you don't understand it, you really just kind of have to let it go.
And I think when I first learnt about this, I was actually kind of relieved in a way, because I was relieved that even the best investors in the world, they have this pile where if they don't understand it, they'll just put it aside. Because I remember when I was learning to invest, I'd just I'd be on some company and I'd just be trying to battle away, and I just wasn't really getting it. And when you don't really get it and you're trying your hardest to understand it, then it's so demoralizing. Because you're like, this is so hard. Like, is this what it's going to take to be a good investor? I'm going to have to learn this company. I just don't get it at all. But so it's really, in a way, when I learned about this idea of having the too hard pile, it was just very reassuring that, like, even the top, like the most successful investors in the world have a pile for the ones that they don't get. Like, they're just human. They don't get it. So they chuck it away and then they move on to something that they do understand. And I don't know, it's so simple, but I guess I didn't even think about that as an option until I saw, like, Charlie Munger and his strategy.
Yeah, I mean, I remember one of my very first investments before I was doing any kind of analysis. I invested in an Australian bank, and I still have that investment today. And I remember after kind of learning this stuff, I was like, okay, let's go back and let's learn everything there is to know about the stocks that I have in my portfolio. And I remember opening up the annual report, and it was about 400 pages long.
Jesus.
So bank annual reports are just...
They're just depressingly long.
They're disgusting.
Yeah.
And I remember just not understanding a thing.
Yeah.
And it's good to be able to... I mean, even Warren Buffett says that, 95% of the businesses in the market, he just flicks off. He doesn't have any interest in understanding them, and he doesn't understand them. He knows the areas that he understands. And he sticks within them. And that way, once you kind of understand an industry, it's very easy to get a grasp on which are the good companies and which are not. Learning a new industry is tough, but once you've kind of got a grasp of the industry and you have an understanding of a particular area, when a new company comes into your line of sight and you're kind of looking at it, you know where to look exactly. You know which numbers are the best indicators of success in a particular business. You know what management should be doing for a successful business in that industry, and it makes it a lot easier if you stick to what you know.
Yeah, definitely. And with that said, let's move along to the next quote. This is a good one. I like this one from Charlie Munger. Excessive diversification is madness. It's very similar. Like Warren Buffett says a similar quote. He just says that diversification is for the ignorant, or diversification is for those that don't know what they're doing. But yeah, take us through this quote.
Yeah, so I guess what Charlie Munger believes here is that we are, as humans, we're limited in how many companies we can reasonably research and understand thoroughly.
Yeah, definitely.
There's a lot of sort of analysts out there their job is to analyze hundreds of companies. And Charlie Munger and Warren Buffett and many other value investors will be in the position where they believe that is just absurd to think that you can thoroughly analyze hundreds of businesses at a time. We're limited. We have limited capabilities. And really, there's kind of two positions on diversification that make sense. There's some in the middle where you have analysts who think they can analyze businesses and they try and analyze 100 businesses. But really, there's two distinct positions, I guess. There's one that is complete diversification. And to me, the way that I think about diversification is that you want to be as diversified as possible if you don't understand what you're doing in a particular area.
Yeah, definitely.
So, for example, if you're just an average Joe Blow and you want to invest in the stock market, but you don't understand how to analyze businesses, then the best thing that you can do is you can buy everything, and that way you just kind of get the average over time.
Yeah, it's basically like it's protection against ignorance. It's protection about not know. So if you're someone that's just just a Joe Blow and you don't want to research completely into it, then the best way to protect yourself against the ignorance that you have in that area is to just diversify as much as you can. But you're right, the other way of thinking about it then on the flip side is that if you are someone that is really paying attention and is switched on, it's just like, well, what are you doing investing in 500 stocks or 100 stocks? I mean, that's not the way that you're going to get ahead. I mean, the way that you as an active investor are going to get ahead is by learning about the best businesses in that area and only picking a few of them, making sure you understand them in depth, and then following your active investing process. Because you're exactly right. Like, how many stocks are you, like, as an active investor, if you are truly an active investor, then it's silly to own more than for me, like more than 10 businesses, because then it's just like, imagine quarterly earnings time comes around and you have to check on 15 different earnings reports. It's just like, holy moly, and they're all coming out in the space of 2 or 3 weeks. It's like, that's rough. That is very hard to do. So for me, like, I don't think I could keep track of more than maybe 6. But yeah, and I just, if you're an active investor, and the other thing to think about is that if you're an active investor and you're trying to beat the market, select individual businesses that you understand and you know will do well, then it's just like, if you own 15 stocks, it's just like, is it really worth buying into the 15th stock? Because it's like, isn't the idea that the number 1 stock is the best stock you've found, and the number 2 stock is the second best stock that you've found? I mean, once you're getting into the 15th best stock that you've found, it's like, wouldn't it just be better if you took that money and put it into the first? That's exactly what I was going to say, is that why would you want to put your money in your 15th best idea or your 25th best idea? Yeah.
If you know what you're doing, if you've been thoroughly analyzing businesses and you know that they're going to be successful businesses, if your best idea or your second best idea are businesses that are going to be very successful over the long term, then it kind of makes sense that you would want to put more of your money into those.
Yeah.
And then the next quote that we had here was that quickly identify mistakes and take action. And this is an interesting one that I kind of found. And I guess once you've been investing and researching for a while and you have more potential investment ideas than places in your portfolio, Munger suggests that you should be more decisive when you discover an investment mistake. So if you've made some kind of mistake, take action to eliminate it. And I guess there's kind of a few core things that I would say sort of suggest that you've made a mistake. And it really comes back down to those 4 key pillars. Do you still understand the business? Are there still competitive advantages? Do you still trust management? Are management still doing a good job? And is the price still acceptable for you to continue to invest in that company?
Yeah. This is one that I wish that I knew earlier on in my investing journey. They always say, I don't know, one of the quotes out there is just like, when you're investing in stocks, you buy slowly, but you sell quickly, or something like that. And I think it's so true, because once if an investment changes and it's no longer a company that you want to be a part of, then you do have to quickly identify these problems, and you do have to take action. That's why I always say that I think a lot of people get complacent if they make an investment in a business and then their investment goes up. Then they kind of get complacent and then they take their foot off the accelerator. They don't really research as hard as what they should into companies. The way I see it is that eventually all of your investments, it's going to be very rare that you are going to stay invested in a particular business forever. Like, eventually something is going to change about that business where it's obviously not going to be the best investment anymore. Maybe it's got a new CEO and they're not acting in the best interest of shareholders. Maybe the company is branching out into an area of business that you just don't understand, or it just doesn't make sense for them to do so. So I think it's important to not get complacent with your investing. You always have to stay up to date with the companies that you are invested in. Even if you've made, say, 100% gain on this position, you can't take your foot off the gas. You have to stay up to date with it, and you need to be able to quickly identify those mistakes, because it takes, the way I see it is that it usually takes a long time for a stock to go up by 50%, but it takes a very short amount of time for it to drop by 50%. So you got to stay up to date and make sure that you don't get yourself into a position where you're complacent and then all of a sudden, the earnings report that you didn't read is actually the one that says their revenue is going to go down by 20% next year and their stock drops by 50%.
Yeah, that's true. And I guess, this is kind of the difficult part of investing, is that you could make a mistake here in two different ways. If a stock price is falling, some people will fall into the trap of thinking, oh crap, I've made a terrible mistake, I need to sell really quickly. Even though maybe it's still a great long-term prospect and there's just some kind of short-term problem going on within the business. So you've got to be able to distinguish between that and the stock price falling and being able to get out quickly of a business that is actually fundamentally flawed.
Yeah. No, that's a really good point, actually. Yeah, you raise a good point. That's true, because a lot of the times if the stock goes down by 50%, then if you're up to speed with the business and you know that you haven't made a mistake, then it's like, oh yeah, you beauty. So, no, that's a good point. Shall we move along to the next one?
Yeah, so the next and last, actually, quote that we had...
No, we've got two more. You missed one.
Oh, we've got two more.
That's
okay.
Right. That's all right.
My mistake.
That's right. You go with this one. Yeah.
Yeah, okay. So this quote was, the only way to win is work, 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 and hope to have a few insights. I like how there's hope in there. It's like you could work, 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 and not have any insights.
Absolute spud. This sounds very Charlie Munger, doesn't it?
It does. Yeah, some of his quotes are just brutally honest and just harsh. No, but it's so true. You just have to work, work, work. You have to be consistently analyzing businesses. Realize that you're probably, if you're following this approach, you're probably going to find one or two good ideas over a year. Yeah. You might even go a year without finding a good idea.
It's going to be a lot of no's.
It's just going to be a lot of work. And you just have to hope that every now and then you're going to find a great business at a great price, and you can sort of capitalize on that.
Yeah, and I think this is important. Like you have to wait until, like, you work, and you hope that you have a few insights. I think a lot of people, when they're working on their investing or they're researching, they kind of work, and then they kind of make up in their brain that they've had a few insights. Like they feel like, okay, I've done this amount of research, therefore one of these stocks must be good, and I think it's this one because of this reason, but they're not really sure of it. So I think it's also about just being disciplined. You do have to just like put in the hours and keep reading about these different businesses, and you just hope that along the way something leaps out at you from within the annual report and you go, this is good. But I think a lot of the times people just they feel like they're reading so much that they almost make something jump out of the page at them, even if there's maybe not too much to read into that sort of thing. But yeah, that's just investing, right? And this ties into the other quote that we were going to bring up, is that the big money in investing isn't in the buying or the selling, but it's in the waiting. And this kind of ties in closely, is that I feel like a lot of people, they're almost researching in stocks, but they're at the back of their mind, they're thinking, all right, I got to make an investment now. I want to make an investment now. Let's invest. But one of the best things about Charlie Munger is that he is one of the most patient dudes ever. Like, like him and Warren Buffett, they could go several years without buying a stock and they'd be like totally fine with it, because they know that it's not worth trying to find a stock that's only half decent and investing in it just because you haven't made an investment for 6 months. The real money in the stock market is waiting for the opportunities. One of Warren Buffett's quotes where it's raining gold and you can go out there with all your cash and you can pick up those killer deals. So I think that's one characteristic or one trait about Charlie Munger that I really admire, is just the patience that he seems to display. Like, he really doesn't seem to be fazed by whatever's going on. For instance, I've seen interviews where he's been asked, oh, what are you doing in the markets at the moment because of this and this and this? And he says, I'm not doing anything. Or he was asked, like, one of the things that I saw was like, are you concerned by the fact that the value of Berkshire stock has gone down now by over 40%? And he's like, I'm not worried in the slightest. It's like, he was basically going on a rant saying, if you're not prepared to see the value of your stock decrease by 50%, at least kind of 2 or 3 times in your lifetime, then you're simply not fit to be a common stockholder. And yeah, I just feel like that's one of the main traits that I admire from Charlie, is that he is just super patient. And that's really what makes him so successful, is he waits for those great opportunities.
Yeah. And I think, tying into the waiting kind of stuff is that a lot of people look at businesses and they'll be a great business, but their price will be super expensive, and they'll just kind of completely ignore it, and they won't analyze it, and they'll never sort of come back to it. And I think that kind of can be a mistake, because part of the
definitely.
waiting is that you need to have a list of great businesses that you would invest in if the price improved. It's not just about trying to find businesses that are great and a great price right now.
Yeah. You probably won't find many right now.
Exactly. You won't find many at all. And it's much better to kind of keep hold of those great businesses that aren't at the right price, keep them in the back of your mind, and keep track of what's going on with them. Because, I guess an example of this would have been Facebook last year. Many people... Facebook's a great business. Some people would argue it's a great business. And for many years, it was overly expensive. It was
it was in the
huge
200s.
Growth story. It was just many, many multiples above earnings.
Yeah.
And in late 2018, I believe it was, or during 2018, actually, it started in February, the stock price dropped over 40%. And really it was as a result of some short-term uncertainty surrounding what was the US government going to do about some of the mistakes that Facebook had made around the election. And none of that really materialized into anything. They got a small fine. It was like $5 billion fine, but small,
like, relatively speaking.
Yeah, exactly. Small for Facebook. Especially since it's just a one-off fine, and now they're back to producing, they don't have to pay that ongoingly. That could have posed a great opportunity, and not many people would have seen that coming, a 40% drop in a company like that. So I guess the message is just to know which businesses you understand, know which ones are really great businesses, and there will be things that happen every now and then that impact them. Maybe they're small and the stock goes down 10%, and maybe it's not attractive, or maybe it is after 10%. But there'll be other businesses that go down 40, 50%, or even more due to some short-term uncertainty.
Stocks drop quickly.
They do.
Yeah, you can look at, even in this bull market, you can look at most of the big companies, and they've had periods where they've dropped 20 or 30% in the last 5 years even. They've had, and usually it happens just over a month or two. So you just have to be ready. You have to take that time to make sure you're ready. Because in the best companies, like, that's the idea, right? We're finding the best companies that we want to invest in. The best companies, the highest quality businesses, they don't stay pinned down for very long. So oftentimes you only get a very short window of opportunity where you could invest at something like a margin of safety price, because people realize, actually, this is stupid. Why is this high quality business going down so far? And they start investing back in, or it pings back up very quickly. So you have to use the time where not much is going on to make sure you really on top of what investments you want to make. I think, is that just about it for Charlie Munger?
Yeah, that's just about it. I hope you guys enjoyed that middle section, and we'll finish off the podcast by going through a couple of Q&A questions.
Yeah, sure.
So should I pose the first one to you?
Yeah, sure. Go for it.
So the first one here was, when is the best time to invest in ETFs, exchange-traded funds? The intelligent investor advises that for those not already invested, it may be worthwhile not investing while the market is hot. As the market is currently hot, should those not currently in ETFs hold off until it cools?
Yeah, I found this excerpt in the Intelligent Investor really interesting as well, because I guess it sounds like a bit of a cop-out, but it's really not. The classic thing that I always say is it depends on what strategy you're running. Because if you've been investing, this is what the Intelligent Investor says, right? They say that, or Ben Graham was talking about, if you've already been someone who has been investing periodically into ETFs, and you've just been going and going and going for some time already, then the Intelligent Investor is saying, well, you could choose to just continue with your periodic purchases unchanged, or you could choose to suspend those purchases until the market is no longer dangerous. They're the words that he uses. But then the interesting thing is that he goes on to say, we would actually strongly recommend you don't start a new dollar cost averaging plan if you haven't started already, simply because of the psychology. If you were to start now and your results be horribly negative, then that would probably put you off of investing forever. So that's kind of what the Intelligent Investor has to say about it. I mean, I probably feel quite similarly. It just depends on what you'd like to do. Like, if you feel as though you're a super rational investor and you want to start with your ETFs now with the dollar cost averaging method and continue, if you've just got to say to yourself, okay, I'm going to be comfortable if the stock market goes down 50% in the next 3 years, then that's okay, because I know that I'm going to keep investing and I'm really going to be holding these stocks for the next 50 years. Well, then from my perspective, there's no reason why you shouldn't start dollar cost averaging now. However, the flip side of that is that if you want to take a little bit more of an active approach to buying your ETFs, then it's just like, well, the market's seems super overvalued at the moment. Maybe I do just want to hold off until it's at a point where I believe that it's no longer overvalued. But what do you think?
Yeah, I mean, when it comes to ETFs, I kind of try and think, if you're trying to be active with ETFs, I kind of try and think what would be the rational way to do that.
Yeah.
And the only rational way I could think that you can be active with ETFs is by evaluating and analyzing all of the businesses in the ETF. And I don't think that that's something people can do. So I always say when it comes to ETFs, I think that you just should not be active. You should just dollar cost average.
Passive or nothing, yeah.
And it seems very counterintuitive, because I guess right now, for a lot of new people, they might think, well, the market's going to come down, so I'm just going to wait. But the ultimate reality is that we actually don't know if it's going to come down. Yeah. Even if it's an 80% chance the market comes down in the next 3 years, it could still hit the 20%. And then you've been out of the market for 5 years and you are much worse off than you would have been if you just dollar cost averaged. Yeah. So it's hard to wrap your head around, but I think the best approach is just to think that when it comes to the market, you just need to accept that you don't know where it's going to go. Very few people can do that. Yeah. And I'd say very little people can do that consistently over many, many cycles. So if you're just an average Joe Blow, then I think just sort of have the approach where when it comes to the entire market, when it comes to ETFs, just dollar cost average. That would be my opinion. So I would just invest, and I would invest consistently. Yeah,
I think that's fair. All right, let's head on to the next question. What are your thoughts on pairs trading? Have you ever heard of pairs trading?
I have never heard of this.
No, so I wrote a little bit down. I didn't really understand what it was. This is from Investopedia. A pairs trade is a trading strategy that involves matching a long position with a short position in two stocks with a high correlation. So a pairs trade strategy is based on the historical correlation of two securities. The securities the securities in a pairs trade must have a high positive correlation, which is the primary driver behind the strategy's profits. A pairs trade strategy is best deployed when a trader identifies a correlation discrepancy. Relying on the historical notion that the two securities will maintain a specified correlation, the pairs trade can be deployed when this correlation falters. So from what I took out of that definition, it seems as though it's just almost like an arbitrage stock investing system. It's just some sort of arbitrage system where you're relying on the correlation to and waiting for discrepancies in the correlation. I don't do this personally. I just, like, to be honest, there's probably so few opportunities that can be reliably exploited like this in the stock market. And a lot of these times, the discrepancies or the arbitrage opportunities are at such a low percentage that you need a hell of a lot of capital to be able to capitalize on the discrepancy. Like, for instance, I've done arbitrage betting before, which is basically going to one betting site and betting one way on a match, and then going to a different betting site and betting the other way on a match. Because sometimes you can find a system where you can invest both ways, and no matter who wins, you can still make a profit across the two betting sites. But even that is very, very rare, extremely rare. So
yeah, and I guess kind of maybe a bit of a distinction here would be that what you just described when you were doing that betting would be a pure arbitrage where there's no risk.
There's no risk, yeah.
Whereas this, from this brief understanding, I guess it seems as though this is more of what you would consider a risky arbitrage, where there's a high chance you're going to succeed, but because you're dealing with two different businesses, I don't. When it comes to this kind of stuff, I just get nervous because ultimately what moves stocks in the short term is entirely unpredictable, which means that you can just get caught out. I mean, you can look at statistics in the past, and that's what a lot of trading is. It's looking at what's happened in the past to see what is likely going to happen in the future. But ultimately, businesses are unpredictable, and I don't think that you can come up with a system like that for trading stocks or anything like that that works consistently in the short term. So I think everyone knows where our position is on this.
Yeah, I just stick to individual businesses. I don't know. I just stick to things that I can kind of be sure about, I guess. But I don't know. I honestly haven't looked into this in depth, so maybe there is a strong arbitrage opportunity that I just don't know about. But yeah, I just be careful. That's all. All right, should we do one more?
Yeah, let's do one more.
All right. This one comes from Jason. What about some advice for super for us dummies? Cheers, guys. Mad work. Love it. Any advice about super? Or not even advice, just like general tips and tricks. We're not in the game of providing advice. Do you have any advice or tips for super?
I mean, I personally don't pay a lot of attention to super, just because I'm self-employed as well. So, I guess, I mean, one thing that you can do is you can max out your super, so you can contribute more pre-tax. That's something that a lot of people do to get a little bit more of a pre-tax advantage. But when it comes to super, I mean, I don't really know a whole lot about it. I kind of don't really like the whole idea of... I mean, it's good for most people, but I think that they take a lot of money in fees, and people really don't understand a lot about how super works and how fund managers pretty much do nothing and take their nice 2%, 3%. That kind of hurts me,
Yeah. For me personally, I try and put as little... This is just for me. This is not advice for everyone. For me, I put as little money as possible into super, because I know I'm going to be able to do better in the long run by keeping it out of super. Because I know that money, like for most people, they should put more into super, because if they don't put more into super, they're never going to invest that money.
Yeah.
They're going to go out and buy a pair of shoes or a new jumper or something, or go buy a new car or something. So I think for the most people, they should just put as much money into super as possible, because, I mean, super is it is like a forced investment account. It's like the government saying, no, we are going to force you to save for your retirement. We are not going to let you be an idiot financially for your whole life. We are going to force you. Make sure that you've at least got something by the time you can't work anymore that you can keep yourself alive. So I think for most people, I mean, it's a good strategy if you can max out your super early and you're not interested in doing this investing stuff like what we are, then you max out your super and it's a good tax effective strategy. And over time, like it might go up or down in the next few years, but over the period of 40 or 50 years, like what you're going to hold it for, because you can't access it till you retire, then you're probably going to make a decent return. Yes, in that process, the fund managers are going to take a lot of that money in fees. So you're definitely going to be helping them get rich, and they'll probably get richer than what you will get. They're going to get much richer than you, but it's better than nothing. But for me personally, I know that all the money that I get, I'm basically investing it because that's what I love. I love to invest. So for me, I know I'm going to be able to do better, all things considered, if I can just use that money myself. But yeah, for most people, it's going to be fine. Yeah.
Yeah. And yep, that's it for Q&A for today. And that's it for the podcast today. Thanks everyone for listening and tuning in. As always, appreciate it. And a big thanks to our sponsor, Hypercharts. Again, if you want to get 2 weeks free trial, a lot of their stuff is free, so go check it out anyway. But if you want to check out their premium stuff, you can get a free 2-week trial if you head over to hypercharts.co/premium. Of course, if you have any questions for next week, head over to the YouTube version of the podcast at youtube.com/Hamish Hodder and leave us a question or a topic if you have something you want us to discuss in the main section, or even a news topic, I guess. If you see something in the news and you want us to check it out, then we're limited in our news research here. So we need a research team.
We do. No, it's all good. We can dig into some good news topics. Yeah.
No, but thanks everyone for joining us, and thanks of course Brandon for joining me as always.
No worries.
And we'll see you guys next week. See you later, guys.
Bye.